Hello, everyone, and thank you for joining us today on the Singapore Fund Manager webcast. The Singapore Fund is managed by Aberdeen and trades in the U.S. under the ticker symbol SGF. My name is Alison DuPont, and I'm very pleased today to welcome our Fund Manager, Christy Fong, on the Fund Manager webcast. Christy is an investment manager on Aberdeen's Asian equity team and is speaking today from Aberdeen's Singapore office, the headquarters for our Asian operations. Christy's presentation will focus on the Singapore Fund and should last about 20 minutes. I'd like to hand it over now to Christy, and welcome Christy on today's call.
Thank you for the introduction. Let's starting with the key facts, or a recap of the key facts of the fund. This is a pure equities and cash fund, so there's no leverage. The Aberdeen Asian team has been managing the fund since August 2011. As of 31st May, the market price of the fund represents a 10.6% discount to its net asset value per share. Okay, so on slide 4, you can see how the fund has fared relative to the MSCI Singapore. It has been a volatile year for most Asian equity markets, with the month of May being particularly weak on the back of concerns of the quantitative easing coming to an end. Singapore was no different. But if you look at how the fund has performed, it was relatively more resilient during the month and actually stayed in the positive territory for the quarter ended May, with a gain of 0.7% compared to a benchmark decline of 0.3%. Generally, we have seen better performance from our core holdings, Jardine Matheson, and some of our small non-benchmark positions compared to some of the large benchmark constituents that we do not hold. These made up for our real estate exposures, which were weak during the period. And although DBS and Singtel form part of our top 10 holdings, we are still underweight the benchmark, so that has also been a detractor to performance. Longer term, year to date, the fund's NAV was almost in line with the benchmark, but in the last 1 year, the fund has done better than the benchmark, rising 26% against the benchmark's rise of 23%. On to the next slide, you see that it has been a rather active year for the fund as we had introduced 2 new stocks. Silver Lake provides core banking software solutions and has a leading position amongst the Southeast Asian banks. We like the company for its execution track record and the healthy level of cash that the management has been increasingly paying out to shareholders. Keppel REIT, which is a real estate investment trust, has high-quality office assets, mostly in Singapore and increasingly in Australia. And from its steady stream of rental income, it's also a good dividend payer. We had partially funded these 2 stocks by taking some profits from newspaper company Singapore Press Holdings that rallied after announcing the spin-off of its retail mall assets into a real estate investment trust. We also swapped our shares in WBL Corporation into Straits Trading, which we felt was the best way to unlock value in the conglomerate, having spent years waiting and engaging with the management to do more with the company. This unlocking of value eventually materialized as Straits Trading had subsequently sold their stake in WBL at a profit. On to the next slide. You see that the fund's positioning remains largely the same, with a bias towards the Asian domestic consumer story. It's not immediately obvious just looking at the sector positions. You see that almost half of the fund is in financials, which is a mix of banks and real estate companies, which to us are good proxies to the underlying economy. Our banks, for example, have been present in the neighboring countries like Malaysia and Indonesia for more than a decade and are continuing to invest in these markets as they offer more growth potential. And you'll see the exact breakdown in the footnote below. The other big portion, and also the fund's biggest overweight, is in industrials, and a quarter of this is in the Jardine conglomerate that has a very attractive mix of businesses in supermarkets around the region, automotive distribution, and other businesses in Indonesia, prime properties in Hong Kong, and a well-known hotel chain called Mandarin Oriental. So overall, it is a great way to get exposure to the Asian consumer. What's left in industrials would be what Singapore does well in. So Keppel and Sembcorp Marine in offshore and marine, FT Engineering, that is a defense, and also more defensive businesses like transport and postal businesses. Finally, we are agnostic about the benchmark, so our fund construction is really based on stock selection, and there is a 10% non-benchmark exposure into healthcare and information technology, where our holdings here are well managed with decent prospects and backed by strong balance sheets. On the next slide, where you see our top 10 positions, I would have mentioned some of these names earlier. So OCBC, UOB, and DBS are the banks that have been growing more in the Asian region. FT Engineering, as I've mentioned, as well as Sembcorp Marine and Keppel Corporation and offshore and marine. The key things to note are that with these top 10 names representing about 60% of the fund, it is a concentrated portfolio, which can look quite different from the benchmark. And the conviction we have in these companies really stems from how well we know them. As you can see from the rightmost column, most of these names are very long-term holdings of Aberdeen. Now moving on to the outlook on the Singapore market, the chart would show the GDP figures. In the latest second quarter, GDP growth was the strongest it has been in 2 years, driven by the manufacturing sector. And the monetary authorities of Singapore is maintaining their guidance of 1 to 3% GDP growth for the year. However, one can see that this has been a very volatile number, and we don't think it necessarily represents what the companies are experiencing. The next slide probably is more important in showing the quality of GDP growth. And one can see how the extent of value-added manufacturing, which is something that differentiates Singapore from other Asian countries that may have a cost advantage. This economic restructuring is still ongoing. The government is now very focused on companies reducing reliance on foreign labor and instead enhancing productivity. So in general, companies that are solely domestic focused and labor intensive will face a tougher time. That's something we've been hearing from some of the retailers we've met. Spending has been sluggish, while rental and wage costs have been on the rise. So on one hand, the low unemployment rate is a positive, but those in the service industry do find it a challenge to find the right people to hire. All that said, if you look at the next slide, many companies have many companies in Singapore have gone regional, with manufacturing companies having their plants located in the neighboring countries, especially Malaysia, while others have gone offshore to seek larger markets where there is more growth potential. The same retailers that we met that were facing a tough time in Singapore are actually more positive about the prospects in some of these neighboring countries like Malaysia and Indonesia. So there is a lot more activity in these ASEAN markets now, especially Indonesia, more recently Philippines. Amongst our corporates, Jardine, for example, has announced their plans to develop property projects in Indonesia using land that it already owns. So there's quite a lot of things going on and a lot of things going for this region. The common characteristics in ASEAN would be the growing middle class and rising affluence amongst the consumers, rising investments, having underinvested massively since the Asian financial crisis in 1997. And corporate balance sheets are generally stronger than before, having gone through the pain of the financial crisis. So, obviously there are risks as well, such as inflation, lower transparency, corruption, and so on. But the beauty of Singapore corporate is that with the generally conservative nature of management and higher accounting and governance standards, Singapore is a safe proxy to this fast-growing region. So you can see on this slide how ASEAN is an important trading partner for Singapore. On the flip side, you also have inward flow of tourists and funds flowing from this region, and that has been on the rise, especially with Singapore now being seen as an attractive tourist destination and a safe haven for wealth management. The next slide is quite interesting in showing how longer term one can see increasing trade liberalization through the ASEAN Economic Community, and that could bring further benefits to the region as a whole, and Singapore being in the midst of it all will be a beneficiary. On the next slide, just to give you a sense of the stock market, Singapore is also seen as a safe haven as well, with defensive characteristics and high governance standards. In the last quarter on the right, you see that Singapore was not spared from the correction, but it still did relatively better than the Asia Pacific ex-Japan index. So while we expect that to continue, one should take heed that the stocks that have done well on low rates may be at risk once that trend starts to reverse. So the next chart kind of gives you a flavor of that, where we've seen how some of the real estate investment trusts and higher dividend yielding stocks have done poorly when investors were shaken by the potential of quantitative easing ending. So stock selection is key, and there are many other factors to consider other than just to simply look at the dividend yield. So next, while we aim to take our companies with a unique competitive advantage and a robust business model that can withstand near-term challenges, whether it's inflation or competition. More importantly, is the strength of the balance sheet that is a reflection of how sound corporate fundamentals are, and one can see that has been improving over the decades. So Singapore corporates, we feel, are much better positioned today. Overall, we are still sanguine for the long-term prospects of our Singapore holdings, but we do recognize the near-term challenges with slowing growth and rising cost pressures. However, there is a price for everything, and with the correction in the recent months, we can also see how valuations are looking more attractive these days. So to summarize, Singapore is a small and open economy that will be vulnerable to what's happening in the global environment. But at the macro level, the country is fundamentally sound with a strong fiscal position, prudent economic policies, and well-capitalized banking system. There are still near-term challenges, especially on low labor-intensive businesses that are domestic-focused. The ongoing restructuring of the workforce dynamics could be a painful process, but it's a necessary move for the longer term. So given the healthy fundamentals of our holdings and the positive outlook we have for the ASEAN region, we are confident that the fund is well positioned looking ahead. And at this point, I'm quite happy to take questions.
Thank you very much, Christy. That was very interesting. You mentioned a couple times about the workforce dynamics and about the decreasing reliance on foreign workers, and that leads to a question about wage inflation. I mean, what is the level of wage inflation in Singapore, and how do you anticipate that may impact the companies in the portfolio?
Yes, it is actually quite a pressing issue, especially for companies that are reliant on labor, or if they do not have, strong enough business models or a business position where they can pass on costs in the form of higher prices. So for these companies, we do expect some margin pressure. But I would say our portfolio is relatively well protected from that, as we don't really have very much in purely domestic-focused companies or very labor-intensive businesses. Many of our holdings have regional presence, and we never believe in the first place in the sustainability of cheap labor. So overall, I think we are pretty comfortable with the way our holdings are positioned, since many have gone offshore, and interestingly, even the ones that are a bit more labor intensive have chosen to move to Malaysia in the earlier years, as opposed to China, where at the moment, wage inflation is actually a bigger problem for companies there.
Thank you very much, Christy. I know that there has been, some press written about that Singapore's shrinking population, and I think that you really expressed it very succinctly about the impact of labor on the portfolios and how the portfolio really is positioned to anticipate that. That wraps up today's webcast. Thank you very much, Christy. That was very informative and a very thorough overview. Aberdeen has other upcoming Fund Manager webcasts on our award-winning Aberdeen Closed-End Fund channel, so please make sure that you are enrolled to receive all our announcements on future Fund Manager webcasts and other films and investment information from Aberdeen by visiting us at the Aberdeen Closed-End Center at www.aberdeen-asset.us/CEF. And again, thank you, Christy, and that concludes today's Fund Manager webcast.
Thank you.